Hi guys, welcome to a simpler approach. If you are new to the channel, please subscribe, like, comment, and share. Now last week we started limited liability companies and we looked at the theoretical approach to same. In this week's lesson, we will be looking at the financial statements that are necessary for limited liability companies. Let's get started. Our primary objective for this lesson is simply to get an understanding of the financial statements that are necessary for limited liability companies. There are three, okay? The income statement, the statement of financial position, and the cash flow statement. For this lesson, we will only be looking at the first two, the income statement and the statement of financial position. Side note, if you are looking at a manufacturing company, a limited liability company, that's also a manufacturing company, then the manufacturing account would be necessary, okay? Because remember that the manufacturing account calculates the cost of production, which is necessary for the income statement in order to calculate profits, gross and net, okay? So that's a side note, bear that in mind, okay? Cool. Now, the income statement, and this is good news, the income statement, the concept, its flow, all of that, as you already know, remains the same. Let me say that again. The income statement, as you know it, its concept, how it flows, what you add, what you subtract, all of that remains the same. The only thing we're doing now is just to add one and two little things that would be specific to a limited liability company. Okay? Now, before your very eyes is the top part of the income statement, the trading account. All right? And as you can see, everything right there remains the same. Nothing has changed. Okay? Cool. For this section, add other income, investment income. That is not entirely just tied to limited liability companies because any company can invest. Okay? So that is really not the new thing. These three things are new. Director's remuneration, debenture interest, and auditor's remuneration. These three expenses are limited liability company expenses. Okay? The salary for the director, debenture interest. Last week we spoke about debentures and we understood that debenture speaks to money that a company borrows. And when money is borrowed, interest is paid on it. Okay? And that interest would be an expense. There we go. Okay? Auditor's remuneration. Quickly speaking, an auditor is an individual who is hired to investigate the financial position of an entity. So that individual or group of individuals would assess the company's finances, their statements, their cash flow, everything, in order to express a true and fair representation of what the company expresses itself to be. So they just say, hey, the documents prepared and expressed represent a true and fair view of the entity. That individual or team of individuals, they are paid for their services. Okay? So that is where you have auditors' remuneration, their fees, their salaries, or their expenses. As I said before, those three expenses are primarily linked to limited liability companies. Now the next section says other normal expenses. That means all the other expenses that you know about. Cable, what's that other one? It just flew out of my mind now. Poof. Oh yes, utilities, depreciation, all those other expenses remain the same. They go in their usual spot. Okay, cool. Profit or loss before tax. Now, before tax is there because limited liability companies, they pay taxes, and it is called corporation tax. So when you subtract the expenses from the gross profit, that profit that you calculate would be the profit before taxes. Okay? After tax is subtracted, it becomes net profit or loss after tax. All right? So the profit that you calculate when you subtract expenses from gross, that's the net profit before taxation. You subtract your taxation and then you will get net profit after taxation. Okay? The part at which is completely new to you is this part. This section is called the appropriation account. All right? And as you can see, this part comes after net profit of taxation, which means everything up top, apart from the few little things that I expressed just now, the expenses that are for limited liability companies and the taxation, everything else primarily remains the same. So let's talk a little bit about the appropriation account. Now, the appropriation account deals with specific items that are specific to limited liability companies. And as you can see there, it says less appropriations, which means that you're going to subtract these things. Cool? First things first. Goodwill written off. What is goodwill? Goodwill speaks to an entity's intangible assets and their image. Okay? It's the top asset of any entity. Intangible assets and their image. Now, sometimes things happen and some of these assets will have to be written off. Same thing as amortized. Now, if goodwill is written off, this is where it is done. Okay? That's the first thing. Second thing, preliminary expenses. Preliminary expenses come into play when those expenses are taken care of before the entity is created or during its creation. All right? Now, when those expenses are being written off, this is where it is done. All right? That's thing number 2. Thing number 3, transfer to reserves. Now, at the end of a financial year, the directors of an entity reserve the right to put aside funds out of profits for various reasons. Now, that transfer that is put aside can be for general reasons or specific reasons. Specific reasons such as foreign exchange, capital replacement, asset replacement, whatever it is that they deem fit to set aside the reserve for, they can do so. Or it can be general, it doesn't matter. So where you see specific speaks to a detailed reserve, foreign exchange or asset replacement or whatnot. So if it is called that, you would put it there. If it's general, you would put it there. All right? Interim dividends. Now remember, when we spoke about dividends in part 1 of this topic, we spoke about interim dividends being dividends that are paid to shareholders during the year. Okay? Those dividends are placed in the appropriation account. Proposed dividends are one of two things. One, dividends that are paid at the end of the financial year, as in they are proposed by the director to be paid, or right, they're proposed by the director to be paid. Or 2, final in this context means that interim would have been paid during the year, or a part of it would have been paid during the year. And at this point, the final amount needs to be paid. Okay, so it's either proposed or final, and that's what goes in that little section that you see there. So it's either proposed, either the director said, okay, we're going to give ordinary shareholders X amount, or we're going to give preference shareholders X amount. Okay, that decision was taken. So that will be proposed. We are going to give them at X time. Okay, or if it is final, it means that it's what's left of what they were supposed to get. So they have gotten a part during the year, and the rest they are supposed to get. All right, cool. So we have goodwill, preliminary expenses, transfer to reserves, interim dividends, or proposed dividends, whether it is preference or ordinary. All right, after you have taken care of all of those things, add them together, subtract it from the net profit or loss after taxation, and you will get retained profit for current year, meaning the profit that is left for this year. Okay? To that, you will add the retained profits brought forward. Retained profits brought forward is retained profit from last year. So you would add the profits from this year and the profits from last year, which would give you retained profits carried forward, which would be the amount that would carry forward to next year. Okay? That's the appropriation account. The basic concept of it, that is. As for the statement of financial position, aka balance sheet, that concept, as you know it, also remains the same. The only major change in the statement of financial position is the finance by section. Okay? I'm going to show you in a little bit. Because the statement of financial position is pretty huge, I had to sectionalize it so you'll see what is happening. So this is the top part, fixed assets section. And as you can see, everything remains the same. The only difference per se is that goodwill comes first. In the order of permanence, goodwill comes first. Okay? And also long-term investments would come last. After everything else is calculated, then whatever the long-term investments are would be added, because long-term investments are fixed assets. Okay? So you'll add those together and you'll get it right there. All right? So that's the fixed assets section. Cool? The current assets section. Now, if you look here, you'll realize that there are a whole lot of things here. All right? But the key thing to note is that all these things are current assets. Stock, debtors, prepaid expenses, accrued income, stock of unused stationery, packing materials, etc., short-term investments, bank cash, petty cash. All are current assets, fit right in their usual spot. Okay? And the total is in the middle. And you're supposed to know why. It is in the middle because we will be subtracting our current liabilities from our current assets, primarily to get our working capital. And you know all of that already. Okay? That is why I said the basic concept of the statement of financial position remains the same. Okay? Cool. So that's the current assets. The current liabilities section and the long-term liabilities section. As you can see, everything, remains the same. Doesn't really change. But I still got to show you. But yeah, doesn't change. Creditors, short-term loans, bank overdraft, corporation tax owing. That is probably new. Probably. But it is a current liability. Taxes are owed. They must be paid in short order. It's not a long-term liability. It's pretty short-term. All right. Proposed dividends, preference and ordinary, accrued expenses, or prepaid income. Okay. All these are current liabilities. Now, for long-term liabilities, debentures are long-term liabilities because technically they are loans. Yeah. right? We just don't call him that. We call him debentures. So for long-term liabilities, we take care of our debentures and any other long-term loan that we may have, probably mortgage or something else. All right. So when we perform our calculation the way we ought to, subtract current liabilities from current assets, and we get our working capital, which is the same thing as our net current assets, which would give us our total assets less current liabilities. Sort out our long-term liabilities, which would mean to subtract long-term liabilities from total assets less current liabilities, which would give us our total assets, our net assets. All right. Once again, the basic concept of that top section remains the same. The major change is right here, the finance by section, which is now called shareholders' equity. Shareholders' equity. Now let's break down this section. Shareholders' equity is made up of two things: issued or paid up share capital and all reserves. Let me say that again. I know you're seeing it, but let me say it again. Shareholders' equity is made up of two things: issued or paid up share capital and reserves. Now, when you are recording this section, you recognize what I have here: XX, X% preference shares of X dollars each. You are being specific. So whatever the preference share is, you must be specific. 100,000, 10% preference shares of $1 each. And you will have the figure amount in the middle, $100,000. Same thing applies to ordinary shares. 200,000 ordinary shares of $2 each. In the middle there, 400,000. Okay, which will be the value amount. All right. So that refers to the issued or paid up share capital that we have. Notice that you don't see authorized share capital there, because the authorized share capital is not necessarily the issued or paid up capital. They can be different. We need the issued amount or the paid up amount. That's what we want, because that amount gives us the a detailed figure, so to speak, of what is expected, a detailed capital amount, as it were. All right. Place those two in the middle, put the figure over on the right. All right. Now to our reserves. All the reserves that the entity has is placed right there. Share premium, and these are just examples: share premium, revaluation reserve, fixed asset replacement reserve, foreign exchange reserve, general reserve. All the reserves that the company has is placed right there, along with the retained profits carry forward that was calculated at the end of the appropriation account. Okay, so all those figures are placed there, added in the middle, brought over to the right, which is then added to issued or paid up share capital, which gives the total shareholders' equity. And you should know this: the end of the finance by section and the net assets section should be equal. Same thing applies here. The total shareholders' equity and the net assets figure should be equal. Okay? And your balance sheet is balanced. That's the overall concept of the two, bearing in mind the old and the new. Okay? Cool. We're going to look at an example where we will, bring this to light a little bit more to give you a clearer understanding. All right? Okay, so this is our example. I tried my best to fit it on one screen so we'll be able to look at the example in its entirety and not break it up to cause confusion. Okay? So what we have here is a full trial balance for Jackson and Sons Limited, along with additional notes that we're going to need to prepare our income statement and our statement of financial position. All right. Take note of the first note. The directors decided to transfer 10,000 to a general reserve, 8,000 to a foreign exchange reserve, and recommend a 10% dividend on ordinary shares. Okay? Now, we're going to use this example and we're going to look at what the income statement and the statement of financial position will look like. And along the way, we're going to look at a few things and, put certain things into perspective. All right? Now, for the income statement, this is what the income statement would look like. Now, this income statement is not filled with a whole lot of examples. All right? But what was shown to you before is the full example. All right? Now, you may not. All right, let me just tell you point blank. Every question will not be the same. You might have certain entries, you might not have certain entries. So although the example I showed you, the full outline, was so long with all the X's and stuff, and this is so short, it doesn't mean that you don't need to know everything that should be there. All right? Let me just make that disclaimer right now, unless someone is thinking about it and it causes any confusion. All right? So, here we have our income statement. Simple, straightforward. All right? And remember things such as provision for bad debt depreciation, all those things that you already know, they are in the equation. All right? If you look in the expenses section, you will see increase in the provision for bad debts. You're supposed to remember those things. You're supposed to remember, for my international students. You should remember those things. Okay? Okay. And if there are any African students, you should remember some of these things or all of these things. Okay? Awesome. There was something here that I must remind you of. General expenses and repair expenses, accruals and prepayments. Oftentimes, I find that students who are preparing their income statement, they will remember bad debt provision for bad debt and depreciation, but most times they forget accruals and prepayments. Whenever you are putting together your expenses, always remember to look in the notes section for your accruals and your prepayments. Add your accruals, subtract your prepayments. It is very essential. Okay? Now, 109,689 is the net profit before taxation. The note said, I think it was note number 3 or 4, if my memory serves well, said that corporation tax is 10% of net profit. Okay, so 10% of this figure would be 10,968. Now, if you look there it is. All right, and then after you take corporation tax from net profit, then you will get the net profit after tax, which is 98,720. Okay, then you take care of your appropriations. Once again, always ensure that you pay keen attention to the additional notes. That is primarily where the appropriations will be placed. All right. So in this example, we have transfer to reserves, we have foreign exchange reserve, and we have general reserve. And we had proposed dividends. Now let me pause here to explain the proposed dividends to you. I think I'll have to backtrack for you to see it. Let me do just that. Note 1, 10% dividend on ordinary shares. Now remember something, and remember it well. Preference shareholders are called preference shareholders for a reason. And that reason is that if ordinary shareholders are paid, it stands to reason that preference shareholders are automatically paid. Remember, they are called preference for a reason. So not because the question didn't say 10% dividend on ordinary shares and recommended dividend for preference. It stands to reason that if it says that ordinary I get something, preference should automatically get what is due to them. Okay? Remember that, please. So don't put in the ordinary and forget the preference. Remember that preference comes first. So if ordinary is being paid, preference automatically is getting paid. Cool? Now, let's look at the bottom of the trial balance. It says 150,000 ordinary shares of $1 each. Now, if ordinary shareholders are getting 10%, it means therefore that they're getting 10% of 150,000, which is 15,000. Okay? Let me go back here and show you 15,000. There it is right there. Okay? Backtrack again. Last entry in the trial balance. 37,800, 5% preference shares of $1 each. It means therefore that preference shareholders receive dividends of 5%. 5% of 37,800. 1,890. There you have it. So that is how you calculate the dividends aspect of things. And I can't say this enough, and I'm going to say it again. Remember, if the question says ordinary shareholders, there's a proposal to pay ordinary shareholders, it stands to reason that preference is paid automatically based on the fact that preference shareholders are paid before ordinary. So if ordinary is being paid, preference is being paid automatically. Cool? I sound like a scratch record, so I'm going to stop saying it. You get the point. All right? So after you've done all that, you add the appropriations together. You get 34,890. Subtract that amount from the net profit after taxation, and you will get for this year retained profits of 63,830. To that, you add retained profit brought forward, which means retained profit from last year, the previous accounting period, which is 10,969, which therefore gives 74,799 in retained profits that will progress to the next year or to the next accounting period. Okay? That's the income statement, which includes the appropriation account. Next, we will look at the statement of financial position. And there it is. Remember that the entire concept, as you know it, remains the same. The only major change is the finance by section, which is now referred to as the shareholders' equity section. Okay? Also remember that for total depreciation of fixed assets, remember we're taking into account provision for depreciation, which represents depreciation that has been charged on the asset before previous years, and the current depreciation charge located in the income statement. We have to add those together because ultimately we want to calculate what the asset values now. Okay? So we have outlined our current assets, our current liabilities, added everything together. We've calculated our working capital, which is the same thing as our net current assets. We've subtracted that up, we've added rather that amount, which is 162,999, to our fixed assets of 135,600, and we've gotten total assets less current liabilities 298,599. Then we have subtracted our long-term liability, which brings it down to 280,599. All right, that's cool. You're supposed to know that part already. This is the part now that we need to just explain a little more. First things first, issued paid up share capital, remember that it is supposed to be specific. Now, if you look, you'll see that it is specific. 37,800, 5% preference shares of $1 each. Okay, 100,000 ordinary shares of $1 each. Be specific. Place both figures in this middle column, add them together, bring them to the third. Reserves, all the reserves and retained profit. Foreign exchange and general reserve, 8,000 and 10,000 respectively, and the retained profit carried forward, which is the last item in the income statement, 74,799. Add those together, put in the third column, add the issued or paid up share capital to the reserves, which gives us our total shareholders' equity of 280,599. That would take care of the statement of financial position, and that would also take care of our lesson for today. All right, financial statements for limited liability companies. Now, I am aware, guys, that the information can be a lot to soak in, but I always tell my students, and I'm going to tell you because you are my student also, two things. One, ensure that you spend adequate time to practice. All right, there is a lot of information coming together, especially the fact that previous information is now necessary for current information and future information. So to remember all of the information, you're going to need to study the theoretical aspect of things, and you're going to need to practice so that the two can come together for you to foster a wholesome understanding. That's one. And two, do not neglect previous information. Remember, I spoke about just now how important it is in the process of understanding. So don't just push the old information to the side and say, I've done that before, I don't need it again. You're going to need it again. All right? So practice, and in practicing, number two, do not forget previous information. It's very essential. All right, guys? So I hope you learned something. I hope the information was clear, and I hope that you learned limited liability companies using a simpler approach. If you enjoyed that video, please feel free to subscribe, leave a like, leave a comment, and share. And as always, if you have any questions, queries, or concerns, please feel free to share them in the comments section below, and I will respond to you directly. Until next time, walk good, stay safe.